BCE has announced a huge transaction this morning. It has agreed to buy Ziply Fiber. That's a big provider of fiber optic internet services in the northwestern United States. The deal is worth $7 billion Canadian, including the assumption by BCE of $2 billion in debt. The acquisition gives BCE, for the first time, a significant presence in the United States. And BCE says it's a market that is ripe for expansion, with fiber optic penetration in that part of the U.S. much less advanced than here in Canada. There's a significant consequence of the deal for BCE shareholders, however. BCE will pause dividend growth between now and at least the end of 2025. For insight, let's go to our featured guest of the morning. He's Dennis Mitchell, Chief Executive Officer and Chief Investment Officer at Starlight Capital. Dennis, thanks for coming by. Always great to have you here.
Thanks, Paul.
Just let me tell viewers a bit more about this transaction. Again, BCE agreeing to buy a company called Ziply Fiber, based in Washington State, active in Washington, Oregon, Idaho, and Montana. BCE will pay $5 billion for Ziply and assume $2 billion of debt, bringing the deal value to $7 billion. This is in Canadian currency. BCE will also pause dividend growth. It says it will not pause its dividend through the period from now until at least the end of 2025. It says it will, the board will reassess the dividend at that time based on the company's payout and debt ratios. Here's more on Ziply. It is, again, based in Washington State, active in those 4 U.S. States that you see listed on your screen. It has 1.3 million fiber locations. That's to say its fiber network reaches 1.3 million homes or business locations. It plans to reach 3 million in the next 4 years. So that's part of the growth story. And BCE says this will solidify BCE's position and enhance it significantly as the third largest fiber internet provider in North America, with 9 million locations and an objective to reach over 12 million fiber locations by the end of 2028. There is a consequence, however, and that is the pausing of dividend growth. Dennis Mitchell, I know you have not had a huge amount of time to look at this, but what do you think of this transaction?
Well, fortunately for me, we actually own a similar business in our infrastructure private pool, so I'm familiar with the industry.
Okay.
So for this business in particular, it's 3 prongs. You want to grow the reach of the network itself. So their plan, right now they have 1.3 million customers they reach. I don't know if they broke it down between consumer and business, but that's important. Mm-hmm. Their plan is to grow to 4 million, I think you said. So you want to expand the network, you want to capture more consumers, more businesses on the network, and then you want to drive rate, and then you want to just continue, right? So it's a very, very scalable business. To your point, there's greater fiber penetration in Canada than there is in the US, so there's plenty of opportunity to grow. But if I take all of the pieces and put them together now, and take a step back, BCE sold its stake in MLSE, which is a very lucrative business, but I guess they judged it non-core. Very lucrative business with strong cash flow growth. They have specifically said that they've reinvested that capital into buying Ziply.
Correct.
And they're going to continue to expand into this, if not, just through Ziply, probably through greater acquisitions. Hence, the dividend growth is being paused. Mm-hmm. Their debt is staying at the current sort of debt to EBITDA level. So if I look at this, if I look at all these transactions in totality, BCE is retrenching into their core business, and they're looking to grow through the core communications industry. Their leverage is going to remain elevated, which is going to put pressure on their ability to grow free cash flow. And if you look at free cash flow, there's 3 uses for it: reinvest, delever, or pay out in a return or a dividend to investors. And clearly BCE has said, we're going to keep our leverage at the same level, we're suspending dividend growth, so you have to think that they're going to be investing a lot of capital into this business mm-hmm. and the core franchise mm-hmm. as well.
How do you think the market is going to respond to the news on the dividend?
I don't think the market's going to like it, right? I mean, you buy businesses. Businesses' present value is the discounted value of future free cash flows. So saying that you're pausing the dividend, you're basically telling the market that we're not going to have a lot of free cash flow, discretionary free cash flow for the next several years. What you do generate, you're going to use to keep your leverage levels constant or to grow the reach of this business.
Do you think BCE has made no secret of the fact that it doesn't think the regulatory environment here in Canada is conducive to growth? Do you see this perhaps, at least in part, as a decision by BCE to deploy capital in a jurisdiction where perhaps there's a friendlier regulatory environment?
Yeah, I would agree, but I also say part of that is because Bell and Rogers have chosen to ignore avenues of potential growth. So, for instance, I think it was Rogers that sold part of their infrastructure assets to an unnamed investor. Both of these companies could solve a lot of their cash flow and balance sheet issues if they just sold their cell tower networks. I mean, we've seen the example in the United States where the telecoms there have created American Tower, Crown Castle, SBAC, and a number of other private tower operators. By
selling off their tower networks to other companies.
Absolutely. Right. That would be a source of billions of dollars of capital. And if they retained a stake, they'd have access to a growing stream of free cash flow as well.